Welcome to another exciting edition of Talking Retirement. We have an amazing guest for you all today. We are going to be talking about long-term care financial planning with Rob Walsh of Bird's Eye Wealth Management. Rob has years of experience in financial planning, and he is going to be talking about how and why you should be planning for long-term care sooner than later. So, Rob, thank you so much for coming on the podcast today.
Yeah, Ken, thanks for having me, man.
All right, so I'd love to know a little bit about Rob and Bird's Eye Wealth Management before we dive into everything.
Yeah, so my name is Rob Walsh. I'm the owner of Bird's Eye Wealth Planning. I'm a fee-only advisor on the investment side. I'm affiliated with Wealth Care Capital as my RIA. And then I have my executive assistant who deals directly with our client management, Judy Dijon, and another advisor who specializes on the tax side in Brendan Sheehan. And both Brendan and I, in addition to being investment advisors, are life insurance license, health license, long-term care license. So, we're able to manage all aspects of the financial plan for clients.
Awesome. No, it's great to have someone with your expertise and, years in the industry to help us out. So one of the things we run into with our clients is we're obviously very Medicare focused. And I think one of the biggest misconceptions people have is that Medicare is going to pay for nursing homes and long-term care. And there really isn't any health insurance that does that outside of Medicaid. So
Right.
how do you fit long-term care planning into someone's financial plan? Like, how do you broach that subject, and what do you guys do to help plan for that?
So I think the number one phrase that I use all the time with clients is if you're not setting aside some of your dollars for long-term care planning, you're setting aside all of your dollars for long-term care planning. And that seems to resonate with people. The reality is the plan should never be to get to Medicaid. The plan should be to plan for a life event. So, unfortunately in this industry, there is a dark side where we have to deal with the realities of life, which can include sickness, illness, early deaths, long-term care events, things like that. So it's not fun to talk about, but I think a good advisor has to talk about it and force the client to evaluate their own situation and what might happen in those types of events.
No, it's a great point. I love you're saying, set aside some now or set aside all of it later, because I don't think
Right.
people realize how quickly you can burn through your cash, your assets, your income with long-term care on your way to Medicaid. And then on top of that, Medicaid is going to put stuff against your estate too. Like, it's just a crazy process.
Absolutely. You don't want the government involved in trying to plan for your care. The reality is, especially in the Northeast, an average long-term care event is going to cost upwards over six figures. It's going to be over $100,000 a year to get the proper care that you want. And the average long-term care event, depending upon male or female, can be anywhere from 2.5 to 4 years. So there is a real cost that can come along with an event like that.
100%. I think one of the biggest frustrations for a lot of people is that there isn't a true long-term care insurance product that people really get behind and talk about. So can you talk a little bit about long-term care insurance and why this is more or less fallen out of favor with not only clients, but also the insurance companies, it seems, as well?
Yeah, I think the original, long-term care insurance had good intentions, and like everything else, it went by the wayside. Traditional long-term care insurance, I think, as most people know it, is not really anything that I would get involved with, and most good advisors do not. And the reason is because it's similar to your car insurance plan, right? It's use it or lose it. You pay a premium, and if we all die happy and healthy in our sleep, which we would hope to, that insurance just goes away. The other dark side of it was there's not guaranteed premiums. So, as a client gets older, their premiums are going up, and you can't stop that from happening. And unfortunately, most people are on a fixed income and just can't afford to keep up with the premiums. So the decision becomes to either cancel the plan altogether and or continuously reduce the benefits to keep the premium the same. And that's not good planning in the long run. You want to know when you sign up for something what you're going to have 20 years from now. So the life insurance companies stepped in and started building products that have a life insurance base, have a life insurance chassis, and have added a long-term care rider to that. So they've solved two problems with doing that. Number one, You know exactly what your premium is going to be, and you can structure it so that it's paid off prior to retirement or not all the way through retirement, or you can structure to pay it for your entire life, but the premium is going to remain the same, which is important. And then the second part is you know that the money's going to be within the family. So if you do die happy and healthy in your sleep, like we talked about, old school long-term care, that plan would have just gone away. But in this case, if you never needed to use the long-term care portion of the plan, the life insurance just passes on to your family. So that you know that your premiums are at least, keeping everything within your family.
No, it's great to hear. I know something we've done when we've talked to people about long-term care insurance is we're like, hey, this costs a lot of money right now, and it's also going to cost even more money in the future. So it's really a tough sell for anybody involved, because it's like, not only is it going to be maybe more than your total Medicare costs per month, but it's going to go up as time goes on. So it's really like a lose-lose for everybody involved. It's kind of crazy if you think about it.
It's a choice. It's a tough choice. It's a conversation that has to be had. And listen, the reality is not everyone can afford to add a plan. If I meet somebody, who's older or doesn't have the health to qualify, it's a risk that you take. But at bare minimum, the conversation should be had. Don't just make assumptions that you know what it's going to cost, that you know how it works. Have the conversation, and then we can decide if it's going to work for you or not.
Yeah, so I really want to piggyback off the conversation about life insurance. So really the two vehicles you see for these long-term care riders are universal life policies and annuities, correct?
Correct. Mm-hmm.
Can you dive into the two specifics, starting with universal life?
Yep. So that's how you've changed the game and gotten to a guaranteed premium, right? So what a universal life policy does is it's structured not necessarily for a cash value plan like you might think of with a whole life. It's structured strictly to have a life insurance benefit with the ability to access it early if you needed it for long-term care. And right into the contract, you'll see that the premium itself is guaranteed. On the annuity side, and the annuities can come in handy when a client may be uninsurable. What the annuity companies have done, it's more of a lump sum program where you can take some of your assets, maybe from an old 401k or an existing brokerage account, put a lump sum into there, and should you need income, we can take income off of that. And then during that time frame, if you had some kind of long-term care event and you needed help there, then there's a long-term care, what I'll call a multiplier. And depending on timing, company, that multiplier can be anywhere from 2 to 3x what you're making on an annual basis. So for example, if you're making $30,000 a year off your annuity income stream and you had either home health care or you needed to go to a nursing home, that immediately will kick up to $60,000 a year till you get through the entire cash value. So it's a great option for someone who's uninsurable and can't get the life insurance in place.
No, it's great to have options too. Like you said, you never know what someone's health is going to be, how old they might be, and how a long-term care insurance company might look at them as a potential prospect. So it's good to have options no matter who you are. In terms
and that's one other important point I would say with the newer age long-term care is that I think there's a misnomer that, although it was kind of factual when it first came out in the 80s and early 90s, is that the only type of care that was covered under these policies might have been what you would think of as a traditional nursing home, whereas now the definition of long-term care and what's needed has expanded greatly with the life insurance companies, to the point that these policies will even pay for in-home health care by a family member or certified nurse, Alzheimer's care, skilled nursing, adult daycare, modifications needed for the home if there was a handicap event, things like that, for wheelchair accessibility. So the ability to access the money has expanded greatly by definition as well.
No, it's great to hear, because I saw an article about a year or two ago that said 70% of people don't want to go to nursing homes. A lot of people want to spend time in their house and, like you said, either have a nurse or have someone get paid in their family to take care of them. I think a lot of people want, the safety and, dignity of living in your own house till the end, basically.
You want choice and options, and that's what this gives you.
Awesome. That's great to hear. When do you tend to broach the subject of long-term care with your clients? Is it 40s, 50s, 60s? Like, how early do you think you should have this conversation?
Typically, I would say, the conversations revolving around insurance and protection, they change. So if you have a family that has children, or even without children, just have a mortgage where they want to protect the spouse, you're typically looking at putting a life insurance policy in place to protect the college education, the mortgage, things like that. And then once the next phase of life begins, and that honestly is getting later than it used to, people are having children later. So there's not a really good, hey, this is the age you need to talk about it. But typically in your life cycle, it transitions from when the kids move out of the house, or you're in a better place financially where you're not so concerned about your spouse being able to cover the mortgage, where you say, hey, we've made it this far, we've protected what we need to protect. Now let's do the same thing as we move in towards retirement. So I would say the ideal time to talk about it is probably in your 50s through 60s, but it's not out of the question if somebody came into the game in their 70s to take a look at it. Again, asking the question to see if it makes sense. But you typically see a transition in the insurance space from protecting children or house to protecting assets later on in life.
Yeah, and I think it's a very important thing that we talk about. We mentioned it earlier, just how quickly you can burn through your assets, and like your legacy can just be gone in a matter of a couple of years. So do you start setting aside money for the long-term care stuff early, or do you wait until people are kind of done with the house, the college, all that stuff?
I wait because I think it's two very clear, distinct areas in your life where you're transitioning from, I believe in insurance throughout your life, but at different times require different coverages, for lack of a better term. And the reality is none of us want to be insurance poor. We want to, set money aside and make sure it's going to benefit us, but we don't want to put every dollar that we have, to insurance for the what ifs. You want to have some fun in life too. So.
All right. So I know we talked, Rob, when we talked yesterday about your bucket strategy and how we can work to, set aside money in the right places. And you were nice enough to send me this graphic, talking about savings, taxes, and retirement. Can you walk us through how you do financial planning with this bucket strategy, just so our listeners and viewers can understand, the basics of financial planning as you go through time?
Yeah, I think, one of the things that I try to accomplish the most as a planner and with Bird's Eye is that, I try to speak English. I try to speak in common terms that people can understand. So, some of these concepts that I've come up with is just to try to a way to try to make a complicated topic into a more simple graphic or explanation. And so I've applied these, 3 different buckets to different phases of your life. In the initial phase, like we talked about with protecting a family, we talk about making sure you have an emergency cash reserve so you don't get into credit card and things like that. On the long-term side, you would think of things like 401k planning, owning a house, a home, things like that. The midterm bucket is where most people that I meet with don't have anything, and that's money that's accessible but earning a rate of return for you, right? Staying above inflation. That would be something you would think of as more like a traditional, what someone might call a brokerage account, investments and things like that. Flip down there to taxes in the middle. So, we've used the term a lot. It's not how much you make, it's how much you keep. So you have different tax wrappers that go around each investment. So I can own Apple, for example, in tax-free, tax advantage, taxable. And if I have $100 worth of Apple and try to cash that out, depending which bucket it's in, what I actually get to keep from that is going to change. So the tax-free bucket would what you would think of as a Roth IRA, for example. A Roth IRA is truly tax-free. So if I put $10 into a Roth IRA today, if I make $10 and I put $1 into a Roth IRA, the government's still going to tax me at $10. But that $1 is going to grow tax deferred forever. And when I take it out, that and the growth is going to be tax free. The tax advantage bucket, I'm going to skip that. We'll hit that last. Taxable bucket would be the opposite of the Roth IRA, right? That would be what you would think of as your traditional IRA, 401k. So same scenario, you make $10, you put $1 into the traditional IRA, the IRS only taxes you on $9. You get to write that dollar off. From there, the dollar grows tax deferred. However, when you go to take it out in retirement, it's fully taxable at whatever ordinary income rates are at the time. So you're taking a tax benefit now for an unknown later. Whereas with the Roth, you're paying your taxes now for a tax benefit later. Tax advantage sits right in the middle, and it's underneath the midterm bucket for a reason. Again, it's one of the areas I see lacking in most people's planning. But again, it's a non-qualified account, what you might more traditionally hear called a brokerage account. And again, use Apple. So if I bought $100 worth of Apple stock, it grew to $200, and I cashed that whole thing in, the $100 comes back to me free, right? Because that was already post-tax money that I put in. And then the tax portion of it is just the $100 gain, and that's tax advantaged because it's lower than ordinary income tax rates. It's taxed anywhere from 15 to 23.5%, depending on your tax bracket. So that covers those three buckets there. And then finally in retirement, again, kind of moving through the stages of life, we have the concept of the emergency fund remains the same. You know, whether you're 20 years old, 40 years old, 60 years old, you know, the brakes can go out in the car, something can happen where you want to have cash available where we're not putting ourselves into debt. And then the biggest piece of retirement income is income. You know, where are you generating your money from and how much risk do you have? So in the income now bucket, think of things like Social Security. Pensions have, for the most part, gone by the wayside, and that's where annuities have stepped up to take the place. It could be bond interest from holdings that you have. It could be stock dividends. And then on that last piece there is that long-term bucket still. You still want to keep that concept even in retirement. You know, what we don't want to do is just be overly conservative and have inflation eat away at our assets. As we keep spending, you could be buying the exact same thing that you were 5 years ago, but you're probably spending, you know, 50, 60, 70% more on that same basket of goods. So the long-term bucket is the ability to invest either in stocks, more so than you think you would, adding that long-term care piece of the puzzle like we talked about earlier. So if you did have an event where you had to pay for something that was pretty expensive, we're able to access that type of funds. So that's where the buckets come into play, is trying to take, you know, a very complicated topic, no matter what area of life you're in, and trying to make it more simplistic and something we could talk about a lot easier.
No, I appreciate that, because I've seen a lot of people sign these massive 30, 40-page documents with financial advisors, and when all is said and done, they have no idea what they signed. And, you know, we're reverse engineering, like, why they're getting screwed, and we're just like, what is happening here? So I appreciate that you but successfully simplify everything to short-term, mid-term, and long-term. And it kind of just comes down to like taxes and liquidity, right? Like the more liquid, the lower the return, the less liquid, the higher the return, and it's a sliding scale. Is that kind of true?
It could be. You know, I've been doing this for 15 years. You know, you can walk into a bank right now and get a CD for 5%. That hasn't happened before over the last decade, certainly, because interest rates from the Fed have been at zero. So we're in a unique time right now. You know, the ability to have guaranteed money and earn 5%, for example, in a money market hasn't been something that we've had the opportunities for. The same holds true with annuities, like we talked about before. The rates that they're willing to pay right now on annuities, both via what we call the roll-up rate, or how much you're increasing every year, as well as your withdrawal rates, are higher than we've ever seen. And those won't last forever. That's the reality. So it is a good time for retirees. I would say, you know, the prior 10 years to this, you had to take what I would say a lot more risk. And when I use the term risk, I think people think in retirement, you know, I don't want to be in the stock market or things like that. But the reality is, if government bonds and money markets and CDs were paying you 2% or less, that's not going to get the job done. So inherently, you had to be invested more into the stock market, which I wouldn't call overly aggressive, but could lead to a lot more volatility. And now things have changed, where you can truly set up a guaranteed income stream for yourself, or a guaranteed rate of return for yourself, while still having liquidity in a money market scenario, things like that. But, you know, in general, yeah, liquidity, returns, all those things are variable. And, you know, I think we're going to see that change again going into next year. But that's my job as an advisor, is keep you apprised of what's happening in the landscape of finances and talk about it.
Yeah, I think something that made me laugh yesterday was you said one of my jobs is telling people to not watch the news or something like that, or not get freaked out about the news. There's so much, you know, there's so much inflammatory rhetoric coming from the finance sector. There's, you know, not only the Jim Cramers of the world, but there's also this whole new generation of what we call finfluencers, finance influencers that also tend to give very crazy advice. How do you get through to people and say, people are saying this, but at the end of the day, we're going to stay steady? Like, how do you keep giving people peace of mind in such a reactionary space?
Yeah, so I think the biggest way to do that is the plan is personal, right? Everybody's plan is unique. So to go to your point, yes, keep not believing everything you read. You could look at the price targets for the S&P 500 for year end at 10 major banks, JP, Goldman. They're all gonna be different. So who's right? Everybody's just kind of throwing a dart. And to say that there's a one size fits all, if somebody walks into your home and they haven't met you before and they've got a prepackaged plan, it's your home, so kick them out. But if you were meeting them somewhere else, run away. Right? So, when we meet with people, I come with a blank notebook. That's it. Tell me about yourself. What do you have? What are you looking to accomplish? What are your fears? What are your goals? What are your dreams? And you build it from scratch. So the way you get people to ignore what's going on out there or not to panic in a major downturn like we saw during COVID or in 2022 in the first quarter is, if you build the plan for that person and not some cookie cutter idea, then you can remind people, hey, we built this plan for a 30-year window. Over that 30 years, I was expecting some things to go wrong. This just happens to be starting earlier than we thought. But then you look at the market returns, for example, after 2022. Last year was great. So far, this year has been great. So volatility is going to come with it. But I think if you get to know the person and the plan is unique, you have the ability to then, hey, we expected some crazy times like this. It's all part of it. We're expecting it. We're not going to panic. The worst thing you can do is just, fold up shop, go to cash, and bury your head in the sand. That's not going to get you anywhere either. So personalizing it to the individual is huge, and then reminding them, what you spoke about in times of volatility can kind of bring some comfort.
That's good. Yeah, you say, hey, it's going to go up and down, but overall it's going to keep going up. So don't panic when it's down, because that's when, I saw some stat, you might be able to know the specifics of it, but it's like if you take your money out just 5 days over like a 20-year period or something, you lose like 20% returns. I forget the specifics, but it's like...
Yeah, it's a pretty famous Dow study. It was if you missed the 10 best days or 30 best days over a 20-year period, your returns were negative, as opposed to an annualized return of the average investor was at 4%, and the S&P was at over 8%. So... missing specific data. There's some holes in that study, I'll be honest with you, but the concept is accurate, what they're trying to portray, which is, come up with your plan and stick with that plan, provided nothing has changed. And one thing I mentioned before also is, hey, the easiest plan that I build is the first one. When we draw everything out and write everything down on paper, and we've talked about what your goals are and what you're doing right now, and we set this plan up and it looks beautiful, it's probably not going to stay that way because life happens, right? And that life could happen the next day. Life could happen 20 years from then. But, the advisor earns his money with the ability to adapt when the original plan changes.
Something you mentioned earlier that really resonated with me, and I think is going to resonate with our viewers and listeners, is this idea of it's not what you earn, it's what you keep. Can you dive into that concept a little bit more in terms of what that really means going forward for people as they financially plan?
Yeah, I think most people don't realize the impact that I think we all realize what the impact taxes have right when you get your paycheck, but I don't think you have a concept of how much taxes can impact your investments. So, if you earn, if you look at your advisor at the end of the year and your rate of return was 10%, but after you paid capital gains tax and income tax on your bond interest, and you had capital gain kickoff from a mutual fund, and all of a sudden and you paid your advisory fees, that 10% really was more like 6%. So that's not a great rate of return. But if you made an 8% rate of return and you netted 7.5%, and you picked up a tax write-off along the way for the next couple of years because you sold a loser stock, it's really important, as an advisor, that when you're going through this, you don't just look at the top line number. It's the bottom line number that really matters, right? what's going into my pocket at the end of the day, and am I being tax efficient in how I'm investing? So a lot of people talk about asset allocation. You hear that normally, right? And that's just how much money do I have located in stocks and bonds and real estate, things like that. Asset location is probably a lot more important than that. And what that means is, do I have the right financial products in the right tax wrapper? So for example, if I've got, Roth IRAs and 401ks and brokerage accounts, that's ideal for an advisor, so I can put different things in different buckets. So if I have a real estate stock that has a great dividend that's paying over 10%, well, I want to put that in the tax deferred account, because otherwise I'm paying taxes on that dividend. I want to put my high growth stocks that don't pay a dividend into my brokerage account, Tesla, Nvidia, things like that have earned a lot of money. There's a lot of gain, but there's no taxable income to speak of, because right now it's all on paper. So, knowing where to put certain things, and if you look in the bond space, for example, you want municipal bonds in your taxable accounts, in your brokerage accounts. Why? Because all the interest that gets kicked off of those are tax-free, whereas a higher yielding corporate bond or government bonds are taxable. So knowing where to put different holdings is important, because again, it's not what you earn, it's what you keep.
Do you find certain financial advisors or planners will tout this very high rate of return, then kind of whisper like, but it's actually only 4%? Like, is that kind of like it's a common marketing tactic? Like, oh, it's 15%, but it's actually 4%, like that kind of thing? Or is
I would
it pretty
hope
common?
not. I can't speak to that. I can't speak to other people doing that. I'll just say this: if outside of something that is guaranteed, like an annuity or life insurance, things like that, if somebody guarantees you something on your investment, it's the same thing I said if they had a prepackaged plan, like run away. I can't guarantee you anything. I can't. I can be smart and make informed decisions about how I invest your money and where I put it, but I didn't know COVID was coming. There's things that can happen in the real world that kind of put best laid, what is the saying, the best laid plans go to waste. So, I can't guarantee a rate of return ever. How aggressive or how much money you have allocated to certain areas should dictate over time what, I can make a prediction about what your average is going to be, but I'm not guaranteeing anything.
No, it's a good way to put it, because I think people want that peace of mind. People want that certainty. And of course they want that guarantee. But like you said, it's so hard to forecast, especially when some of these products could be 2, 5, 10-year commitments, or even longer in some cases. It's like, we have no idea what's going to happen in 10 or 20 years. And anybody who tells you they do is just lying to your face.
There's no magic bullet in this industry, right? Financial advisors, for the most part, have the same tools. It's how you utilize them with the individual. The reality is that each thing is going to have a positive and a negative. Like, you're going to have to accept the bad in order to get the good that you like. So, for example, in an annuity, you might like the guarantees. The negative might be a less liquidity than a typical investment. On the flip side of that, you could buy Nvidia and double, triple your money, but there's no guarantee the stock's going to keep going up. So, there's a trade-off with everything.
Yeah, no, it's a great way to put it. Are there tax implications when you roll between these different accounts? Like, let's say you move from like a more liquid to a less liquid, or tax advantage to tax deferred. When you make these rollovers, are there short-term tax implications or long-term tax implications with any of this, or are you able to move between them pretty seamlessly?
No, if you're ever changing the overall tax wrapper, that's something that you want to really dig into and understand. What am I going to keep out of this? So you hear the term rollover a lot. That is an easy switch, right? When you contribute to your 401k, you get towards retirement, then you roll over your money to a traditional IRA. There's no penalty there, because you're picking it up from one tax wrapper and moving it to another that's in the tax deferred space. But if you were to say, you hear a lot about Roth conversions, for example. So if you want to take some of your money that's in your 401k and move it into the Roth space, now you're crossing over tax wrappers, right? You're going from tax deferred to tax free. So if I take $10,000 from my traditional IRA and convert it to a Roth, that $10,000 is now considered income, and I have to report it in that specific tax year. The benefit is I don't pay taxes on what I've rolled over now, but I do have to pay taxes on what I've just converted. So you have to be really careful moving in and out of tax wrappers and what the ramifications are going to be.
Makes sense. And obviously, I'm sure that becomes a very more in-depth conversation when you get into specific numbers and everything. But
Right.
for how much we talk about numbers, I think one of the biggest aspects of all this planning is the human element, is the emotional element. And, the topic of the podcast is specifically long-term care financial planning.
Right.
I think one of the hardest things we run into with clients is that they just don't want to talk about it, period, because it is such a sad thought. It is such an existential long-term thought that a lot of people just don't even want to broach the subject. They say, I'll never do it, but we know that 70% of people are going to need to do it in some capacity. So how do you personally break through to people that it's something they need to focus on, not in the future, but now in most cases?
Personally, breakthrough is a tough way to put it, because I'd be lying if I said I'm always successful. But it's not a topic that I'm afraid to broach with people, because I've been doing this long enough to see the dark, as I mentioned before, the dark side of financial planning is going through some pretty tragic life events with people and families. So long-term care, wills, life insurance, that's just part of what I talk about those as openly and freely as I talk about investing in the stock market, because that's true financial planning, is talking about the uncomfortable stuff. You see it not just with long-term care, but even just trying to convince a family to do a will and naming a beneficiary, for example, for their minor children. Well, we can't agree on who we're going to pick. Okay, well, do you want a random judge in family court to pick that for you? Like, somebody might not be happy, but I guarantee you, like, once you put it down on paper and know that that's done and know that everybody's accounted for, you'll feel better about it. And again, with long-term care, it's not so much about putting it in place that I'm more concerned about. It's about having the conversation and seeing if it's something that we can work into the financial plan, that the money's there and that it makes sense. So as I said, the biggest thing that I encourage people to do is go out and buy long-term care tomorrow. That's not it. It's have the conversation, see if it works for your plan. Because, as we both know, the same things don't work for everybody that you meet with. But for a lot of people, I think it's a lot more affordable. I think it's a lot more flexible than people give it credit for.
Yeah, I find something we talk about a lot is, we're in our 30s, our friends are in our 30s, and a lot of our friends are starting to buy houses, have kids, and keep trying to pitch life insurance to them, knowing that they need it.
Yeah.
But they don't want to have that conversation. But then if I talk to my cousins who are in their 40s and 50s who have seen the spouse who got left behind with nothing because they didn't have life insurance, for them it's like such a no-brainer because they've seen it. It's almost this weird dynamic with humans where, like, we can't need something till we've seen it negatively happen, but like you have to plan before you see that negative thing in a weird way,
Yeah. And so both of our jobs is to keep bringing up potential holes in the plan. But you're right. The only time I ever personally get a phone call where someone says, hey, I want to explore long-term care, is typically when they're taking care of mom and dad in that moment, and they realize, how damaging and destructive it is, not just for mom and dad's life, but for their life too, because they're trying to work and raise a family, and they have to set aside a couple hours a day to go take care of mom or dad, that can't get out of bed or, needs help getting into the shower, things like that. So, someone experiencing it in real life, it's a lot easier to have a conversation. You're right. It's a human thing where until we see it, we're like, it won't happen to me. But
yeah, like I'm not going to
I can tell you that.
that.
I can tell you that it's possible.
Yeah, no, I think one of my biggest things is once I took this job and I was dealing with older adults, you start to see the importance of financial planning and everything, not only for quality of life, but just having the options you need for healthcare and housing and everything else. Like, you don't realize at a certain point, you might just not be able to work anymore, whether that's due to disability or, ageism. At a certain point, you might just not be able to work. And it's pretty sobering to see that once you see it up front.
It is. And, I'm like anybody else. My car insurance bills, my health insurance bills, medical, and then still paying a copay, and, part of responsible for, I just got a bill from the dentist for going for a regular cleaning. So I get it. Insurance isn't fun to talk about, but, what at minimum we can do is show how insurance can plug the potential gaps in the plan, right? It's almost like if you have this great plan with no type of life insurance, no type of medical or long-term care, no type of disability insurance, and you're still actively working, it's like having a house without a roof. It's unprotected.
Yeah. It's like, oh, this is all great until it rains one time, then
That's it.
everything kind of falls apart.
Exactly.
Yeah. Well, Rob, this is awesome, awesome information. We always appreciate your expertise and your time. How
Sure.
can people find you? How can people find your company if they are looking to talk about their financial planning?
Sure. The website is the company name. It's www.birdseyewealthplanning.com. You can reach me via phone, 609-532-1090. It's one of the ways I truly hope I do differentiate myself. You're not calling an 800 number and, getting bounced around. That's my cell phone. So I always say if I don't answer, I'm either with another client or at one of my child's sporting events. Just leave me a message and I'll get back to you. And then you can reach me via email. Again, it's the company website. It's rob@birdseyewealthplanning.com.
Awesome, Rob. Well, I will link everything below for everybody who is listening and watching in case you want to get in touch with Rob. We have known him for a very long time. We think he is an awesome, awesome guy. So he comes highly recommended from us as well. Rob, thank you again. I hope you have a great rest of your summer, and we'll talk to you soon.